Welcome to this explainer. Look, if you're an institutional leader or a corporate executive trying to make sense of today's deeply confusing macroeconomic environment, you are absolutely in the right place. Today, we're unpacking the highly critical findings of the May 22nd, 2026 Economic Fragility Index. Our goal? We want to give you a crystal clear signal through the noise of what is arguably the most complex market setup in recent history. Let's get right into it. We're actually going to kick things off with this brilliant analogy right from the source material. Think of a snowfield. You look at it and it seems absolutely pristine, perfect, completely safe. But underneath that calm surface, internal stress is loading. The avalanche doesn't start when the snow actually begins to move. It starts when the unseen tension exceeds the system's capacity to hold it. Understanding how invisible stress builds beneath a superficially calm surface, well, that's the absolute key to navigating today's market. Okay, here's our flight path for today. We've structured this specifically to give you the bottom line up front on the systemic risks ahead without getting bogged down in jargon. We're covering the illusion versus reality, the deep fault lines, the two-speed global economy, the path forward, and finally, the avalanche warning. Section 1. The illusion versus reality, decoding the structural paradox. We really need to begin by exposing the massive disconnect between what the market feels like right now and what the underlying economic data is actually screaming at us. It's what the report calls the structural paradox. On the surface, the index shows this low-risk score of 22.5%, a mathematically safe greenfield reading. But here's the catch. That score is built almost entirely on human emotion. It's driven by all-time equity highs and optimistic sentiment. Meanwhile, beneath that surface calm, the true foundation, the structural indicators rooted in actual economic health, are literally flashing bright red. The system is carrying maximum structural tension, and it's being disguised by maximum market confidence. Section 2. The deep fault lines. Let's look at the 3 hidden danger zones. The crucial point here is that we must look exactly at those red flashing foundational cracks obscured by all that market confidence. First up, the Buffett Indicator sits at a staggering 233%. Just think about that for a second. The historical average is right around 90%. So a reading of 233% means publicly listed companies are valued at more than twice the size of the entire United States economy. We are looking at an all-time historical extreme, which means any adverse shock is going to produce much, much larger market drawdowns than normal. Next, the cap ratio hits 41.87. Now, this metric adjusts share prices against a decade of corporate earnings just to smooth out the short-term noise. Placing current equity valuations at nearly 42 puts us in the exact same dangerous historical company as the 1929 crash and the 2000 dot-com peak. The market is basically priced for absolute perfection in a world that is remarkably imperfect right now. Adding fuel to the fire, U.S. office vacancy sits at 18.6% for the first quarter of 2026. Nearly 1 in 5 offices is sitting virtually empty. They're like modern ghost towns. And because the banking sector holds all this debt, they are kept deeply in the structural danger zone. The data shows this isn't recovering anytime soon, meaning financial system balance sheet risk remains incredibly elevated. And beyond the extreme valuations and real estate distress, we have a brutal squeeze happening on the real economy. The Fed funds rate is stuck at 3.625%, while Brent crude has spiked 61% over the last year to over $104 a barrel. That's largely due to the partial closure of the Strait of Hormuz. So you've got high interest rates plus soaring energy costs, and that combo is severely crushing consumer purchasing power and jacking up corporate input costs. Real wages are actually falling. Section 3, the two-speed global economy. Let's talk about this massive macroeconomic bifurcation. To truly understand this global pressure cooker, we have to zoom out. We're seeing stresses split the world into 2 wildly divergent economic realities. This divergence is honestly unprecedented. The West is trapped by massive government debt and rising yields, what economists call fiscal dominance. Opposite to this, China is drowning in a deflationary domestic collapse, leading to a massive balance sheet recession. Let's look a bit closer at the West. Driven by that fiscal dominance and foreign sell-offs of US Treasuries, Western governments are slamming into a structural yield wall we just haven't seen in decades. The US 30-year yield has broken 5.1%. The UK is over 5%. Even Japan is nearing 3%. The U.S. government is rolling over trillions in debt right now, which means the Fed is structurally constrained. They can't raise rates without blowing up the deficit, and they can't cut rates because of high inflation and oil shocks. They are completely boxed in. On the flip side, China's domestic confidence has just completely collapsed. Real estate investment is down 13.7%, vehicle sales dropped 15.4%, and their 10-year yield is hovering near a stagnant 1.75%. Consumers and businesses there are focused entirely on paying down debt, not spending. And because their domestic market can absorb what they manufacture, China's basically being forced to prepare a massive deflationary wave of subsidized exports to just dump onto global markets. Section 4. The path forward. Let's look at the 6 probabilistic scenarios. So how does this data build into actual outcomes over the next 6 to 18 months? First, we have to acknowledge that analysts are deeply divided on how to read this current data. The framework impartially presents 2 valid interpretations. Interpretation 1 argues we are facing entrenched structural inflation driven by energy constraints and government deficits. Interpretation 2 argues this is just a temporary energy shock, and the bond market is actually pricing in a massive policy mistake where the central bank will overreact, raise rates too high, and completely crush consumer demand. To map this out practically, the framework provides these 6 forward-looking scenarios side by side. Think of this as your executive roadmap for strategic planning. They range from a 25 to 45% chance of demand destruction and a policy error recession, to a stagflationary plateau, all the way to a highly disruptive valuation correction that reverses those historic stock highs. There's also a geopolitical soft landing scenario if the Strait of Hormuz reopens, but even that likely transitions right into fiscal dominance sovereign stress. Shortly after, take a moment to really evaluate your own exposure against each of these probabilities. And that brings us to Section 5, the Avalanche Warning, Systemic Stress Accumulation. This is the culmination of the report, a highly sensitive diagnostic tool measuring the system's hidden internal stress load. The framework features an SRA paradox alert, and guess what? It's currently active. This alert triggers when market consensus is so confident in stability that participants take on massive risk, extend leverage, and reduce their hedges. Sound familiar? Right now, private clients are holding a massive 65% of their portfolios in equities, with under 10% in cash. Blind market confidence and maximum risk on positioning are actually accelerating the fragility of the entire financial system. So is the market actively creating its own trap? For sure. Currently, high-yield credit spreads sit at an artificially compressed 2.76%. This number acts as the critical percolation bridge for the whole financial system. If this spread widens by just 24 basis points, we're talking a tiny fraction of a percent here, it crosses the threshold where currently isolated stresses, like the commercial real estate crisis or extreme corporate valuations, link up and cascade system-wide. All the scenarios we looked at suggest these credit spreads simply cannot stay this compressed forever. I'm going to leave you with this final provocative thought. The economic avalanche hasn't started moving yet, but the structural loading is at absolute historical maximums. You now know the fault lines hiding beneath the surface. So what is your next move to protect your organization? Thank you for joining me for this explainer, and I highly encourage you to apply these insights to your strategic planning today.
This video is produced by New Corporate Management Proprietary Limited, NCM, under the Insight Matrix brand. It is provided for educational and informational purposes and does not constitute investment advice, financial product advice, or a recommendation to buy, sell, or hold any security or financial product. The Economic Fragility Index Framework, EFI, is designed to describe systemic constraint conditions using structured methodology applied to publicly available data. Nothing in this video should be construed as a guarantee of future outcomes, a market timing signal, or legal, tax, or accounting advice. All probability estimates are subject to the NCM epistemic warrant audit confidence ceiling and are capped at 75% maximum warranted confidence. You must apply independent professional judgment to any strategic or investment decisions informed by this video. All indices used in this video remain the copyright of NCM.